So now you're at these billion-dollar hedge funds, but now you're off on your own. How did that
Yeah,
work, and
so I had.
what's it like working at a smaller
Well, that's
fund?
great. So I had no. So I, after my daughter in 2015 became very ill, and at this time, the firm I was a partner at was morphing into a family office. After many years, the partner was winding it down, and I wound up. My daughter became very ill, and I said to my wife, I'm on the road all the time. I'm traveling. I'm just gonna chill. I'm gonna relax. I don't want to be part of that next generation that was going on there. And so I don't know. I was still I'm still relatively young, and I said, okay, I will. I'll just relax and manage our own money, and we'll see what happens from there. And I want to be around because I was weekend dad. When you're traveling a lot and you're working a
Right.
lot, I wanted to be more ingrained into the kids, I was freaked out when my daughter got very ill, and so that's what I did. And then, thank God, my daughter started to get better several months later, and my wife basically said to me, "Okay, you're driving me crazy." Yeah, I've, you know, I, we've been married
My wife says
at
that
that
to me
time.
too. It's
We've
a
been
weird
married
thing.
20 years. I've got the house routine down pat. You got to go find something to do because you drive me nuts. So basically, I just started. I was starting to get more as my daughter started to get better. I was more involved in just looking for my own investments. What's interesting, and and it was really the latter part of 2015 where I read something. I really don't remember what it was, and I read something about the uranium and nuclear power sector, and and I know me. I know my desk has a lot of papers on it. I'm a paper guy, and I print something, and it sits there, and then I probably read 20 other things, and then if I go back and look for it, and I come back, say, where was that thing? I want to read that again, and I found myself doing that with uranium, and it started to really intrigue me. And if I think I sent Patrick something. If you were to look
Yeah.
at that
Right.
chart on page 3, Patrick, that one up from there. That. Well, at the time I was looking at it, I think it was down even. Yeah, it was around 80-90%. And I said, well, that's interesting to me. But at that time, I didn't really know much about uranium. Back in '07 at the peak, and 2011 after Fukushima melted down, my team, I had them look at it for a very brief period of time, but we had a full plate going on, and they said, look, this is pretty complicated. It's pretty opaque, so we didn't spend much time on it. So I really didn't know much, but I knew enough to just keep coming back to why is that down so much? And uranium is, it's the feedstock for nuclear power, but I'm really not that sure about nuclear power. And that was really like the latter part of 15 and early 16. And I just kept reading about it. And I said, and I made the decision. I said, I have time now for this. So when you have a portfolio of stocks and you're managing other people's money across a diverse set of industries, when you have a number of positions in the portfolio, not a ton, but a fair amount, and you have analysts that you're working with, you don't necessarily have the time to dive into every new idea you see. But now I had nothing but time. So I said, okay, I'm going to take the time to learn about nuclear power. Let me understand it. And really the only point of reference I had on nuclear was, I knew wind and solar were on fire, and there were always component makers. And early on in the early days of these big growth industries, there's some interesting short opportunities because prices get way out of whack. But again, I was on the periphery there. But I said, let me understand the role of nuclear power in this new power generation world. Where does it stand? And I started to reach out to some friends who were working on the buy side. And I said, get me some models if you can. Let me see what's going on. Let me look at the sell side, the analyst models on some of these uranium companies and any nuclear power stuff. And what I started to realize when I started getting the research to me, that the uranium mining research was stale. It was dated. It was old. And there was not a lot of information. And it kind of made sense to me because When you see an industry implode like that, what you're typically going to see is those in a niche industry like that, those analysts get fired because they don't generate commissions, and that's not a profit center really for the bank. So you had dated research. What really started to intrigue me a little bit was, wow, look at this. The market cap of the industry at one point was over $150 billion. And when I started looking at it, it was, if memory serves, 4.5 or 5 billion. And I said, wow, so the commodity price is down 80, 90%. The number of companies went from 500 who were doing uranium at the top down to, I think it was 50. The market cap had imploded. The sell side is gone. What if this is a perfect, could this be a perfect hiding in plain sight type thing? And I didn't know. And I said, let me look. So as I started to read about nuclear power, I started to read the importance of nuclear in the world as a baseload source of energy. I started to look at it compared to wind and solar, and there is a role for wind and solar, but its intermittency is somewhat detrimental to it. To store the power is very expensive, and I'm going back now. Those costs have come down, but they're still quite high. And as I started looking, I said, I think there's a complementary role here versus the other. And this was before Greta Thunberg. This was before nuclear power clean air. People are cognizant of it, but it's taken on a life of its own the last couple of years. But at that time, I said, okay, let me just kind of figure out what the demand drivers are, because what does it cost to produce a pound of this stuff? And as I started looking at that, because the research from the sell side was current and the market cap had been destroyed, most people don't like catch falling knives. They don't like catching them. So the institutional ownership was gone, which to a value guy you kind of like. But I also, because of that, I said, let me kind of put the number who uses these reactors. Well, how many are there? Well, let me go find that data. Well, when are they licensed until? What types of reactors are they? How many do they use in a year? How many for this? And what's the cost to pull it out of the ground? And when I saw $45, $50, I said, wow, what's the price? The high teens, low 20s? How long can that last? Right? Because if the cost to pull it out of the ground is twice what it's selling for, something's not right there. That doesn't last. And the question is, what makes it change? And so as I started to put a spreadsheet, really open up an Excel spreadsheet and start going through every reactor in the world and how much will they consume each year. When I did that, it's a tedious effort because it's hard to find that. It's not hard to find, but you've got to compile it yourself. You've got to take the time to do it one by one. And when I did that, I said, I could pencil out a scenario where this thing, nuclear power, can grow 2 to 3% a year, and it's being priced as though it's going out of business, and it's 12% of the world's electricity production. It's 20% of the U.S. electricity production. Something seems disconnected here, unless I'm missing something, and I very well could have been. And so, but that was enough throughout early part of 16 for me to start to really say, okay, I could see a demand picture here. And when I looked at what the old models were, I thought, wow, they're pricing this as though it's just done. It might be a negative growth business. And I don't see how that is. And I took a list. Of these 30 countries producing nuclear power, when are these when are these reactors scheduled to shut down? What's the chance they'll be relicensed? And you have to read a lot and talk to people because every country is different. What's the competitive environment like? Is it the U.S. where half the electricity markets that nuclear power produce in are unregulated and it's open to competition? Well, that's somewhat of a challenge. And then what's each environment like? And again, I had time. So it was I dove into it, and it was a great exercise. And I concluded on the demand side, you know what? I think the market, whoever the market is, because the sell side is really not forming a consensus, I think some of the estimates out there by the industry, quote, experts are wrong. I think they're taking a recency bias. And I would start to read some of their information. I would get my hands on it. And I'd say, wow, this is mired in what's happening now, not what needs to And then it was also mired in, you can't avoid the fact that that most of their production was being produced well below where it cost to extract it. And so then that sent me out on an errand to go take a look at the supply side. And then I started doing the supply side analysis. How many uranium mines are there in the world? How many uranium, what do they produce? How much have they been producing over all of these years? Are there other sources of supply? Yes, there's secondary sources of supply. Well, what are those drivers? And as I started doing that, I started to learn more and more about the secondary market and government programs that were put in place where the Americans, the world was worried after the wall fell in the early 90s that the Russians would take many of their intercontinental ballistic missiles and sell them in the black market. So they put a program in place to downblend the uranium, which was highly enriched for bombs, and downblend it for use in civilian power. And there was a deal in place from 93 to 2013 that flooded the market. And then you had the Fukushima event, which also added more uranium. And the market started saying, well, until the Japanese come back online, there's too much uranium. And I thought, well, it's got to be. And it turned out there was. And so it wasn't just about Japanese restarts, because in my modeling, I never accounted for many of them coming back online. And what I saw then was, wow, there's still too much supply here. But if you ever got a production cut, you would have to, the market would start to re-rate. You need to see supplier discipline. And I couldn't figure out what struck me as odd in looking at the analysis is, as I was looking at the production numbers, I said, okay, Fukushima melted down in March of 2011. Why were the uranium miners producing more uranium in 12, 13, 14, 15? Why were they doing that? And what I came to realize in learning, peeling the onion back on the market structure, is most of the miners were protected under very long-term contracts because fuel buyers were worried about security of supply, because there's no substitute for uranium, that they typically would contract for 7, 8, 9, 10 years worth of supply at one time. And as I started looking at the contracting numbers, what I realized was, well, something doesn't make sense here. Why were they contracting 220, 40, and 50 million pounds a year during peak pricing when prices were, that's $130 a pound, 137, 125, 120, 110. Why were they contracting like there's no tomorrow at those prices? And yet when the price of uranium was $20, they weren't contracting anything in the early 2000s. And so what I realized, and we could talk about this, the structure of the market, but what I realized was the miners were producing because they thought they were covered under long-term contracts, and they figured the market would kind of come back to normal. And there were a few tweaks that caused that not to happen. And so as I started really in 2016, now I'm getting into the latter part of 16, I said, wait a second. They're not going to have a choice. They have to cut supply. You can't produce, no matter how good a CEO you are, you can't produce something for $45 or $50 and sell it for 20. And these contracts were starting to roll off. And as soon as I saw they're starting to roll off, I said, well, that's where they'll be forced to have discipline, because they need to pull supply out of the market because they won't get the price they need. And so one thing led to another, and I spent really, I don't know how many thousands of hours in the latter part of 15 and 16 and really understanding it. And then I started going to nuclear industry conferences where I could go talk to fuel buyers, and I could talk to producers, and I could talk to people who traded the commodity. And my head would hurt throughout 2016. I said, my God, this is by orders of magnitude the most complicated thing I've ever looked at. Not even close. And then but that started to get me really excited, because I said, if the industry is left for dead by Wall Street, and if it's left for dead by pretty much everyone, but it's really not left for dead by those who need clean baseload power, and it's going to keep growing, there's an opportunity here. And so that was kind of my really strong period. And by early 2017, I think it was January of 17, we saw the Kazatomprom, the state-owned entity out of Kazakhstan, the number one producer in the world. They cut their production by 10%. And I said, aha, this is this is the one. And I had been reading a lot and listening to people talk, and they said, well, the Kazakhs are state-owned. It's a lowest cost producer in the world. They'll just keep pumping it out. And I had started looking through, and at that time they weren't a public company; they were a private company, but they had debt, and because of that, they did issue an annual report. And as I was able to glean, going back many years through their reports, I said, this isn't really as low a cost producer as people think, because one of the things I noticed was that they had their costs. I thought the best I was able to piece together were quite higher than now in early 17, where people were thinking about they were. And then I looked at the currency, and I noticed that they had devalued the currency significantly, dramatically against the dollar. And I said, oh, well, of course. They cost in tenge, and they sell in dollars. So their costs, as the price of uranium is coming down, people think they just happen to be this wonderful low-cost producer, and they are, but not nearly as much as people think they are. They're getting a huge boost from the currency here, because when you cost in tenge and sell in dollars and you devalue your currency, you benefit from that. Yeah. And that really was a big margin aid for them. So I started to just put that mosaic of information together, and then we started to see throughout 17. And that's when for the first time, I shared this with a former boss of mine. And I said, am I missing something here? And he has a lot of experience in the natural resources space. And I looked at plenty of resource companies, but I said, I want to get a clear look here. I feel like I've got to be missing something, because the supply and demand numbers, I could see that the supply has to come offline. Demand isn't as bad as people think. Tell me what I'm missing. And I sent this to my buddy, who I used to work for, and who I have immense respect for. And he's retired now. And as a young man, he retired. He had a very successful hedge fund and closed it down to focus on his family. And he came back to me, maybe a month later. He said, "You're right. This is asymmetry here." And so we talked it through, and that's where he said, you should start talking about this to people and solicit feedback. And I appeared on Real Vision TV. He knew somebody there, and they were interested. And I gave this presentation, and then that got picked up by some natural resource conference in Vancouver, who said, hey, that's an interesting thing. Would you come out here and talk about it? I did, and I shared my views on the geopolitics of the uranium market, the risks inherent in the geopolitical landscape, and where a lot of the production comes from, being Russia, Kazakhstan, and Uzbekistan. And I noticed that the U.S. was buying 99% of its uranium from foreign sources, and half of that at one point was Russia, Uzbeks, and Kazakhs. And I said, wow, how's that possible? Like, I guess it's possible, but there's a lot of risk there. And so I shared that. And that started to gain traction. And then...
So, Mike... Yeah, so what I wanted to just kind of dig a little deeper. So obviously, it's been a story that you've been following for 4 years or more. 2016. I was out also speaking at the Vancouver Resource Conference. So I always hear these uranium investors out there. But I mean, we're lacking clearly a short-term catalyst. I mean, it's been 4 years of a lot of the same thing being repeated over again, but yet we haven't seen that catalyst that has really set in motion turning of the tide. What do you feel will be the trigger?
Well, it's a good question, Kevin. But you haven't heard these same catalysts that we talk about. I've seen those conferences and those presentations, and quite frankly, they're pitiful. I don't know how somebody, to be truthful, be as frank as I can. Some of the biggest issues in the market nobody was talking about, which is underfeeding, which is a secondary source of supply. And so what you had in the marketplace was essentially what's the equivalency of shale production and horizontal drilling in the world of nuclear power. In the world of oil and gas. You had kind of a similar change take place in the 80s and 90s in the nuclear power industry at the enrichment phase, where but nobody talked about it. And what I mean by that is, when you when you did horizontal drilling and you were able to start getting a lot more production out of it, get through the tight oil, right? And you were able to produce like crazy over the last decade here in the U.S. That was a technological shift. And what happened in the nuclear power phase, and I didn't see anyone talking about this. I stumbled upon this back in 16, was underfeeding. And what that means is, I won't get into the physics of it, but at the enrichment phase back in the 80s and 90s, they went from gaseous diffusion technology to centrifuge technology. And it was just the way the technology they used to enrich uranium. It comes out of the ground in its natural form with an energy content of 0.7%. And it's got to be enriched up to 4 to 5% for nuclear power, and it goes to 90% for bombs, above 90 and above. And as I started looking through that, what you realize is that the cost per kilowatt hour to keep an enrichment plant open using a centrifuge technology is 98% less than it is to run a gaseous diffusion plant. And so as those plants were being wound, as Fukushima, when it melted down, you had a lot of excess capacity in the world. So you had all these centrifuges with separative work units is the unit of work it's called, excess capacity. And the way it works is they're allowed, the enrichers can extract more uranium, enriched uranium product for an order that it actually calls for. And as long as those centrifuges are running, they keep them running. The cost is very low. The marginal cost is very low. And they're able to substitute really mine supply, if you will. And they were doing that to a significant amount when capacity went offline. And people weren't, it just wasn't being discussed. And so we started to really understand and dive into that side of the market and understand the math involved, and the tail assay assumptions that are used. And if lower tail assays are used, what does that do to SWU capacity? And so as we started seeing all of those, I started to conclude in probably early mid-17 that there's a very finite life to this excess supply coming into the market, because that capacity will be sucked up. And you fast forward today, and it's dropped off a cliff, and underfeeding.
It has, right?
Yeah, and so when I see the old bull cases, they were, and I hate to say it, they were uninformed. If you were they were horrible. They were bullshit. They were ridiculous is what they were. If you were buying these stocks in 14, 15, 16, and 17. And so why was 17 an important year? And why did I start Sachem Cove in the middle of 18? Because of a delivery waterfall that starts to, in the prior period, like I said, you might have had 40, 50, some years, 20 million pounds of contracting in the late 90s and the 2000s. And then in 2000s, when Cigar Lake flooded in October of 2006, you saw the market, you saw people, fuel buyers go in and panic. And they were contracting at 210, 240, 250 million pounds per year of uranium, like I said, versus what might have been 20, 30, 40 million pounds a year. And those contracts are 7, 8, 9, 10 years. And as I started looking at the delivery waterfall, right, you have to lay out how many pounds were contracted, over what years were they coming into the market, when does that fall off? Well, that started to decline at about the 17, 18, 19, 20 period. Well, the fuel cycle is 18 to 24 months. From the time I say, hey, Mr. Miner, I need some yellow cake, and the time it goes through that process, that's how long it could take. So I said, okay, well, we're starting to get into a period where we're starting to see deliveries start to fall off. We've had a lack of contracting. We've had tremendous under-contracting versus consumption for quite some time. And so I said, well, that math is starting to get interesting to me. And as I started to look at, the producers and how much they were contracting, and I said, wow, this is interesting. You're starting to see them buy. How much are they buying? They're buying a heck of a lot less than they're consuming. And I laid out the math, and when I did that math, I said, wait a second. They've got to start coming in. They were always contracting, but not a cycle, not coming in mass. and as you start, right?
Yeah.
So I said, okay, so now you're up against supply is being cut. And then it starts to, you got to start really peeling the onion back on pricing, right? So what is the price of uranium? You're seeing that thing, that's the spot price that I'm showing you right there. The spot price is total bullshit. And so there's two prices. There's the spot price and there's the term price. And the term price is what triggers the long-term contracting. Now, the long-term today, for instance, the spot price is right around $25, and the term is 30.
What page do you want me to be on?
Yeah, let me go. Let me pull up what page you could go on for that. Let's see. Do I have term on here? Yeah. So go to. I'm just trying to see what I sent you. Just bear with me. Just hang on a second.
Yeah.
I'm just pulling up so we're on the same page because I'm looking at my bigger presentation that I use for investors. Okay, here we go. So if I go to, if you take this down to, here, go to, go to page number 4.
All right.
And you'll see a green line going across. If you look at that math, 65% of the global producers today don't make money. They lose money at today's prices. If we look at there's roughly 190-ish to 200, averaging 196 to 200 million pounds a year of demand over the next several years, and we're higher. I'm talking where consensus is. We're not monstrably higher, but we're one consensus is 170 something, but the World Nuclear Association, which is much closer, is about 196 a year for the next 10 years. We're higher than that.
So Mike, we had a mutual friend, Harris Cooperman, their Cuppy, on the show, and his way was wanting to play it through the uranium participation. He was going right after the investing in the uranium price itself. What's your take? Do you go? How do you play? Do you go play the uranium, or do you play the individual stocks? Like, do you go after a Cameco? Like, what's your way of approaching investing into?
Yeah. So well, you got to understand what. So go to slide 7. You asked why now, right? And then we'll talk about how you express the view. Slide 7 is a chart with a lot of lines on there, and you'll see the first Kazatomprom cut was in January of 17, and then the stock had a bit of, the sector had a bit of a move, but there was still oversupply, right? The market's not completely stupid, and then it came up and it came up and then it started to move up again, and then MacArthur River from Cameco, they announced in November a big shutdown. And what we started to see in that fourth quarter of 2017 was something you hadn't seen in a while. You started to see multiple utilities come into the marketplace to go in and start to contract for uranium. And that was a good sign because you said, okay, they're starting to get off their pants, get off from sitting and starting to get off their hands and start to come into the marketplace. And that you would start to have price discovery. Now you had two big producers cutting supply, and you would start to see real meaningful pounds being put out to bid. And those take several months to negotiate. It's not something you don't just say, okay, here's the bid. They go back and forth. There's many rounds. They could take, in some cases, a few months to 6 months. In other cases, a couple of years. That's how long a negotiation can take because you're talking meaningful pounds being negotiated. And then you'll see that little blue line in January of 18. You had something that has cast a pall over the market for quite some time. We had two small U.S. miners file the Section 232 petition in the United States. And without getting into a long, drawn-out explanation, it was very simple in the sense that the 232 petition was two U.S. miners asking the U.S. government to investigate the basically dumping of uranium by the Kazakhs, Russians, and Uzbeks, and asking them to recommend to President Trump that the United States nuclear power plants buy 25% of their uranium every year from them, from the U.S., versus the 1% they were buying. When that happened, those bids got yanked, and people sat on their hands. And then, so the process was the Department of Commerce did not need to even investigate. They asked the Department of Commerce to investigate, but there was no timeline as to whether or not they would investigate. So the market, the buyers said, well, wait a second, we don't know who we're going to buy this uranium from. Are we going to be mandated to buy from U.S. guys? And that really put a pause on the market. And that it took 6 months before the Department of Commerce even agreed to investigate it. And then it was another 9 months that they had to investigate, and they took every single day of that 9 months. And we at Sachem Cove happened to be a source for them. They reached out to us and asked us to provide some insights on the Russian, the Kazakh, on the fuel cycle, which we were happy to the extent that we could. And then that turned into more time. And then over the summer in July, Trump said, I don't think it's a national security risk, but the U.S. fuel cycle is at risk. So I want to put in a working group, and I want this working group to be, it's basically made up of the cabinet, to investigate and come back to me in 30 days. And then it turned into 90 days. And then that turned into another 30 days. And then here we sit today, not knowing the outcome. It's more likely.
Right.
Yep. So you're asking,
Mike, it's
yep.
Kev here. So that actually expired today, did it not?
No. Those are waivers. That's a different. Those are waivers that the government has waivers against Iran, and they sanction, and there are sanctions against Iran. In nuclear power, they have given waivers to those who do business in the nuclear power space in Iran. And it's very meaningful. It's completely separate from this trade policy action, though. Very different. And that's created this overhang in the market because you haven't seen wholesale contracting. But however, with that trade policy and that lack of wholesale policy, you've morphed into 2020, and you've got a couple of issues. It's now every 60 days, but it was every 90 days that these waivers would come up for renewal. In other words, is the U.S. going to sanction any company that does business in the nuclear power space with Iran? And if they do, that would have really big implications because Rosatom, the state-owned Russian atomic energy company, does business there. And the U.S. buys a lot of enriched uranium from them, from their subsidiary. And if that were to happen, it would impact how much fuel the U.S. buyers can get from them. They've already had purchase agreements with them. They would have to scramble and go out to get them. The U.S., the European utilities, all these contracts are priced in dollars. Even if they went to price them in euro, the European banks won't touch it because they don't want to be sanctioned by the U.S.
Right.
So, but every 90 days it comes up for renewal. Now Pompeo is saying no more waivers, but Mnuchin has won the last couple of rounds, right? But that's neither here nor there. What it magnifies, though, is the number one concern a fuel buyer has is security of supply. And you ask, why now? Why now? Why tomorrow? Why 6 months? But why not 2 years from now? Is because it's about inventory drawdowns. And because of this lack of contracting that's taken place over the last 7 or 8 years, because of that lack of contracting, the U.S. utilities, the European utilities, it's been a sucking sound of inventory that they've been drawing down. When you go back to the last, as the last cycle was turning, the commercial inventories in the U.S. were about 2.5 years or so. You're below that right now. The Europeans were 2.7. You're below that right now, and you're at a point.
But Mike, why is the spot not responding?
Because
yet?
spot's a bullshit market. Well, you're asking spot is a nonsense market, and here's why. Spot market normally trades 40 million pounds a year, 30, 50, but 50 is a big number. In the last 2 years, it's traded 89 million and 62 million pounds. In a given year, 65 to 70% of that are traders churning pounds back and forth. I'm selling 100,000 pounds to you for a quarter. That's what that market is. The utilities coming into the market are a tiny portion of that. The producers buying above their delivery book are a tiny portion of that. It's the best offer market, not a transactional market. What's the offer? These are churned pounds by traders trading for scrapes. That's what that is. That's not real demand.
But why wouldn't a utility come and buy a Uranium Participation Corp, which owns all that uranium, and just say, okay, I can buy this for half the price of the kind of forward contract? Is it just not big enough?
Well, they have what, 18 million pounds. That's what that would be. One utility that's using a couple of million pounds for 10 years. You've got 60 utilities in the world. It's a meaningless number. What uranium participation has. That's a way to play a net asset value play is what UPC is, right? So is it traded at a premium or a discount? What's the premium going to trade when uranium's ripping, and what's the discount it trades when it's not? Today I think it's at a 10% discount, right? But in the world of pounds, it's meaningless, right? They're contracting when the cycle's turning. They're contracting 200 to 250 million pounds a year. They own 18 million pounds. It's a rounding error. So UPC is not.
Okay, so that's basically it's just too small, and it's just like an orphan little.
And they don't buy spot kind of. So people look at spot and they say, well, why isn't it moving? The question people should be asking is, go to the next slide. It's slide number 5.
Right. Okay. Uranium spot price since the bottom.
Since then, it's May 17. Now, so somebody who doesn't believe the cycle, they would say, well, why isn't there's too much supply out there? Well, if there's so much supply out there, you would see the prices continuously making new lows, and it's not. It is up almost after that. That's a month old. It's up over 40% since the bottom. You've had trade policy action that's created. Now that's just spot, right? And you've had no demand in there. 65-70% of pounds being traded in the spot market is not producers. It's not utilities. It's traders. Those are literally pounds that switch back and forth. They're 150,000 pounds. So and these guys don't take a view. They're trading for what can be 25 cents a pound or 20 or 15 cents a pound. And that goes back and forth and back and forth. Right. The amount of pounds physically delivered in 2019 was 10 million pounds. Now that's in a market whose demand is 190 million pounds and whose supply, primary supply is 130. So they're meaningless pounds. Right. Now the price that
right. Okay, so Mike, how do you play this then? So if you don't buy the spot, or you can own the spot, that's one way. Yeah. But for big money, how is this going to manifest itself? So it's an opportunity of a lifetime in that this thing's trading way below the cost of production. How do you go out and put on a trade that, at 5 years from now, you're going to wake up and go, I'm glad I did this.
Well, the first thing is understanding what the price is, because the next leg of that, you have to understand this as to how one wants to express that view. The second price that is the one the utilities are going to key off of is the term price. That's the long-term contract price. Anything that starts over 3 years. That has been and the average price when the spot price was $137 back in 2007. Utilities on average were contracting at $90 a pound. So today that price is $32 a pound. Now that is still meaningfully below what you would pay what it costs to produce a pound of uranium. And if you were to look at all of the producers, if you said, okay, let me go and look at all the tier 1 production that's out there that people think can produce at these prices right now, that's about 42 million pounds of uranium in a market that needs 190. And then you say, okay, let me go see all those pounds that if they didn't care about profit, and they just wanted to break even, that can produce at today's spot price or long-term contract price. Long-term contract price, you're around 80 million pounds, right? We're still not half of consumption. So the term price is sitting at 32 is not a real curve. Now, why is that? So how can that not be, right? You and I look at commodity markets all the time, and the price curve is the price curve because of the reporting methodology of the price curve. It is very unique to uranium is it's a best offer reported price. And so what people don't see is what's happening in the off market. And what they don't see is that there are contracts that are signed at higher prices than the term price with a 4 handle that don't get reported by the price reporter. Well, how is that possible? Because these are negotiated contracts that go back and forth and back and forth. And if somebody were to come in with a lower bid that knows they're not going to get those pounds, so why would a utility buy pounds with a floor handle when term pricing is 32? Because it's not just about the price. It's about security of supply. Is this a producer that we know has a producing mine or will be in production that will produce? Are there environmental, ESG, environmental, social, and governmental issues that we need to be concerned about? Are there limitations on origin of where this uranium comes from that we need to adhere to?
But then, Mike, shouldn't then we speak? Sorry, I'm sorry to interrupt, but shouldn't then we be seeing that in the numbers? No. Shouldn't why shouldn't that come through in the accounting?
Would you?
Well, if they're doing trades at 40 and like in essence selling at 40, even though the reported market is in the 30s, as they report their profits going forward, you should start to see it, shouldn't you? And shouldn't the companies disclose we just sold X amount at $40
well, I'm
or
glad you asked, because then that goes to the opacity and understanding how the uranium market works. In every single contract, there's a non-disclosure agreement where unless they waive it, and it's very difficult to get waived. A trader might come out and say, we signed a contract. Itochu and Mirabini will come out and say, we signed a contract with the Uzbeks. But between a utility and a producer, no. And if anyone was paying attention, they would have listened to the first quarter Cameco call, where they signed 25 million pounds at a price they need. Read their 43-101. They need $43 a pound. And then even further in public discussions, they've said they're signing with a four handle. So when you think about that, the market's choosing to ignore that because the term is staying at 32. Well, why is that? Because it's a best offer. If you just think about what that means, somebody can offer a lower price, it gets signed at a higher price, and it does not get reported at the term as the term price doesn't move. And the price reporter will say, well, a rational buyer would have paid that lowest bid for it, which is beyond ridiculous. The rational price is where a deal got done.
Right. I hear you. You're basically saying there's some crappy company. It's like somebody on Kijiji or eBay offering something, and you're worried they're not going to be able to deliver that what product. Right?
You're worried,
and so therefore you have to ignore that.
You're saying you're going out and saying, okay, I make it up, right? I need 2 million pounds a year for 8 years. I'm making it up. I need to know that I have surety of. I need to go to bed at night as a fuel buyer knowing that that's the price I'm paying. Now, that's starting to take place and has been taking place. The pipeline of those conversations in the marketplace are occurring.
So you would argue the turn has already happened. It's just that we don't realize it. So therefore, is the best play to go buy the Camecos of the world?
That's a great question, Kevin. It depends on what one's risk profile is, right? So if we go back, and I unfortunately I don't think I put that in there, but in these charts, but the price of uranium is up. Even from the 232 petition filing, where all of this, they've gone on pause, it's up by, I'm going to say 8-9%. I could be wrong, but that's about roughly what it is. While the equities are down 25%, right? The equities are down 25%. So somebody has to have a risk profile to understand, how do you have a disconnect between supply destruction, demand that's come out? The World Nuclear Association in September came out with their demand numbers. And for the first time in 8 years, they raised their profile. Now, we can get into a whole other discussion about the forecaster in the business and how we spoke publicly against their numbers back in October. And those numbers have come up to what the market might not even know, because it's hidden behind a paywall from a subscription that is a fortune to buy. Is the main forecaster in the industry took their forecasted deficit in late November from 2026 down to 2022. And it's easy to argue against down to where it's now. But even if you believe the 2022, the fuel cycle being 24 months, here you are. And so but these fuel buyers are not. So what you need, though, to see more wholesale changes is, it's like in any business, it's the 80-20 rule, right? So 20% of the people do 80% of the work, and so those who are doing their own analysis, you got to remember the cost of uranium is single digits as a percentage of operating a plant. If you are operating a coal or a natural gas plant, it's 80 and 90% of the cost. So now you get to when you start to see more of these deals start to cross the transom, and all of a sudden that term price has to move up because you don't see it in their P&L because they don't get delivered. These are long-term contracts. By definition, deliveries don't start for 3 years, and so they don't.
I get it. So there's the key. So even if they sign a 40, it really doesn't start printing at 40 till 3 years from now in the accounting. And the fact that they're not allowed to announce it, and it's these non-disclosures that you don't really realize the market has already turned.
You said it better than I said it. And so, and why has that happened? It's happened. So now the spot price, the crazy thing about uranium is people only really have a spot. They can't see the term unless they subscribe to these price reporters. They stare every day at this futures contract, which is basically non-existent, but they look at it, which is keyed off of spot in a market where over 2/3 of it is just churn. It's trader churn. And producers are buying a little, right? The volume of physical delivery uranium is nothing, and it's 10 million pounds last year. So now, how do you play this? Now, it depends what one's risk profile is, right? So if where do we view? What does Sachem Co view? I see a lot of people on Twitter. They think they look at the last cycle, and they say, well, these stocks were up. Everyone goes to a stock and they say, oh, it went from a penny to $10. It went from it was up 50 times, 30 times, 50 times. We don't think that exists. We think there's really big upside in some of the equities. But a lot of these companies have diluted themselves to kingdom come, right? So you have to take that into account when you're looking at valuation. So we think they're.
Well, not only that, Cuppy talks about the fact a lot of them are just holes and swaths of lands with some uranium and some a resource estimate about how much is underneath.
Absolutely.
And they're speculating on that thing. And really what you should be doing right now is buying the people that are producing. Should you not?
Cuppy and I are good buddies, but Cuppy likes to tell people what they should be doing. I don't like to tell people people should be doing what they want to do. And Cuppy, if you're listening.
Okay, well, tell us what you're doing. What are your
Cuppy and I we chat every day. And Cuppy's got his view, but Cuppy is a crazy smart guy. Made a lot of money in the last uranium cycle. He doesn't live in the uranium cycle, though, right? We live in the fuel cycle, and there are a number of companies that do that, right? That they play the pounds in the ground game. They go out and acquire pounds, and why do they do that? Because the lazy way of analyzing pounds is EV per pound in the ground, right? So, what's the enterprise value of the company? How many pounds do you have? But the question you got to really peel the onion back on is, how many of those pounds are economical? How many of those pounds are bullshit pounds, right? But people tend not to do.
Right, because you still need to make a mine. If you don't have a mine, then it doesn't matter how many pounds. So give us your.
If you're looking just to do that. So if somebody says, look, I think that I want to. Where do we think? We think the price of uranium. Does it get to 100, 125? I have no idea. I don't worry about that. What I worry about is where it needs to get to. Right? Where does it need to get to incent production just to meet that get close to meeting requirements? You're looking at around $55, $60. Now, people will look at that, Kevin, and say, oh, well, the Kazakhs can produce. Well, they don't do the math. This is fourth grade math. You got to look at how many can produce those pounds and at what price. Even those tier one production pounds right now have a 68% utilization rate. Why? Because they're not making anywhere near the money they need to make. Point is, that's where, does it need to get to 55, 60? We think so. Now, here's the thing. This market is so ridiculously opaque. The fuel buyers, the average guy, who even now, if he's forward thinking or she and wants to go secure pounds, they've got to walk into their chief financial officer, their chief nuclear officer, or their risk manager, those are the three, and say, hey, Bob, I want to buy a $55 contract today, term is at 32. Now, unless they have real sway, they're going to say, sorry, Bob, sorry, Jim, its term says 32. Yeah, but it's not really there. Well, I need to see it published higher. Well, as those deals, which have the demand and the pipeline of those deals, as more of those start to come, the price reporter has no choice. They can't say, oh, it was a random 25 million pounds. Now it shows up, right? So what happens, though, is because of that lag, because of that delay, and because the market's not paying attention, because it's left for dead, no institutions are there, what winds up happening is 55 becomes 65, becomes 75. And then if you go back and look at historical purchasing patterns, it's crazy. You ask yourself, how is it possible that at the peak you're contracting two times your consumption, when at the bottom you're contracting 40% of your consumption? What are you doing? But that's the market, right? So now, here's the thing: people will be romanced by what they think are generational, life-changing returns, and in some of these companies there are. But in some there aren't. You've got to know if you're playing the equities, you have to know which ones are the real companies and which ones aren't. So when you look at producing,
so which ones are the real ones, Mike? We're going to put you on the spot.
Because I don't talk company.
Oh, you're not okay.
Oh,
I get it. You're not allowed to.
I can, but I don't.
I understand. You're actually have compliance
issues.
Well,
no, I don't like to promote any companies because it's not. I don't like to promote companies. That's not my thing. We own.
Well, okay. So let's talk in general. Would you not agree that you're better off with companies that are actually producing and that aren't as speculative?
Well, so I'll give you a flavor for the composition of our portfolio.
Sure, that'd be great.
So, we believe that there are those that are just some really world-class assets that will need to go into production that have great economics, and those would sit towards the top. So they don't have to be a producer right now. They don't have to be going into production tomorrow for that to happen. But we think the disconnect between the value, and we don't value based on what a CEO says. We do it based upon project economics and based upon what we think a company is inherently worth. So there are a couple of really terrific, great world-class type projects that we place great value on that would have a higher percentage of our portfolio. We also place great emphasis on those who have produced before, are producing now, might be on care and maintenance, or are close to going into production. That's very important to us also, besides quality of asset, is because when the market turns, markets like companies that go from cash consumptive to cash producing. And when you can go from...
Right. So you're actually almost looking for the higher cost producers that aren't producing right now because it's not efficient. Not a higher cost producer. The stuff that the higher cost miner that is actually not producing, that will, once the price comes up, will actually kick in and give you the most leverage.
And that's higher cost has to be defined, right? So tier one producer, like a really, really low cost producer, is there's something interesting there, but you need those tier 2 pounds. They need to come in. Those tier 2 pounds that can produce or near development, those need to come into the market. And again, we have to look out over 10 years because that's what the contracting cycle is. So we need to look and say, well, who's going to come in? And then really it's right. It's doing your project economics on a project by project basis, and what's the cash flow of that project, and discount it back, and what's it worth. So yeah, we're now I will also say, for some people who love to just purely speculate, some people say, I'm going to go to the highest cost potential ones down the road because they're going to get the biggest bang and they're going to get a ton of leverage and people are going to go crazy for them. Or I'm going to go find that tiny exploration company who's been out there for years looking and looking and looking. What you tend to see is when the market turns, these things go parabolic, right? But that comes down to risk reward. Are some of those donuts? Probably, if the market didn't turn right away. But will some of them have really big exponential price increases? Are some of them heavily promoted? Yeah, we stay away from those. There are a few of them that we'll we'll do a little bit of a financing, just like anyone else could do. We'll do a private placement where we can get some warrants that might extend 3 to 5 years. But they're a small portion of our portfolio, right? So if a couple of them went to zero, I don't even, it doesn't impact performance that much.
You wouldn't even notice.
But
anyways,
I think people need to be
listen,
careful.
Mike,
so Kevin,
sorry.
real quick. On the physical, if somebody is somewhat not risk averse, but if somebody just says, look, where's the price need to get to? Well, it's 25 today. Does it need to get to 55? Yeah, probably it does. Those vehicles are great. UPC, Yellow Cake, right? Those you can express your view that way. We think if the price goes up 2x, the real quality and the companies that have operational gearing to that can go up more if our work is right. And again, we can always be wrong. We think we're right, but that's kind of how we think about it.
Well, Mike, I hate to cut you off. I'll tell you, I'm in Cuppy's camp. I love the U. I think it's just dirt cheap. It's a limited downside, and you get kind of sitting around waiting. But listen, for people who want to learn more about you, I first of all, make sure you follow Mike on Twitter. He's a great follow. You engage people. You actually spend a lot of time. I was actually amazed. I wrote an article the other day about it, and I was shocked at how much you went back and forth people. So why don't you tell people how to follow you on Twitter and where they might, for those who are interested, where they can get more information?
Well, first off, I got to say, people need to be following you because you educate me all the time on your seriously. I mean, you are, I'm a macro uranium guy, but on the macro stuff, on the big picture stuff, I mean, you're a fantastic read. So
that's very kind of you to say. My knowledge is an inch deep and a mile wide. I don't know much about it that
that's
much.
Great. So, but that really, I mean, but for me, I'm on Footnotes first on Twitter. I engage sometimes I don't, because what you find, Kevin, is so many people don't put the mosaic together and they come out with one random data point and they think it's important and then they keep insisting on it and then I'm just going to mute you.
Yeah. Well, the other thing is, Mike, I was shocked. I wrote this article about uranium and you got involved, and I was just absolutely floored at how heated it became. And it seemed to me that there was a whole bunch of investors that had really kind of gotten themselves convinced that this was the next great market. And when it didn't pan out right away for them, they actually got very bitter. And I was thinking to myself, these people shouldn't be speculating in this. They are just not the right investors.
We talked about earlier in the call, Kevin, you're 100% correct. You got to learn how to scale and understand risk reward and what's your risk tolerance. Yeah, I sure for people who've got beaten up, but you didn't have to get beat up during this downturn. So, during the equity downturn, not the physical downturn, meaning of the last, couple of years where it started to trade up. So anyway, I really appreciate the time. It was, I really enjoyed it. They were great questions. So thank you.
Well, thank you very much. So, and if you want to follow Mike, it's at Footnotes First, and your website is sachemcopartners.com.
Exactly.
Great. Well, thanks again. Thank you very much for your time, Mike.
Kevin, I appreciate it. Thanks.